Welcome to the AI Research Roundup. I'm Alex. Today we're looking at a paper trending on X published on February 26, 2026, just yesterday. It demonstrates that when you decompose investment analysis into fine-grained tasks instead of using broad instructions, a multi-agent large language model system achieves significantly better risk-adjusted returns compared to conventional setups. The paper is titled, Toward Expert Investment Teams, a Multi-Agent Large Language Model System with Fine-Grained Trading Tasks. And as we'll see later, the results highlight just how critical specific task design is for the performance of autonomous financial agents. Alright, let's look at how this team is actually structured. Figure 1 provides an overview of the multi-agent trading system, organized into 3 hierarchical levels to mirror a real investment firm. On the left, raw input data, including stock prices, financial statements, and news, feeds into level 1. Here, specialized agents like the technical, quantitative, and news agents process the data to generate initial scores and reports. Then, at level 2, a sector agent refines these outputs by comparing them against sector averages, while a separate macro agent evaluates broader economic trends. Finally, at level 3, the portfolio manager agent synthesizes everything to produce a final investment score for each stock. So, with the architecture defined, Figure 2 presents the main performance comparison. Here, the authors track the Sharpe ratio, which measures risk-adjusted returns across 5 different portfolio sizes. The pink boxes represent the fine-grained model, and the blue boxes show the coarse-grained baseline. For portfolios ranging from 20 to 50 stocks, the fine-grained approach significantly outperforms the baseline, as shown by the stars indicating statistical significance. The only exception is the smallest group on the far left with 10 stocks, where the difference is negligible, likely because the small sample size introduces too much noise. Well, while Figure 2 showed the general trend, Table 1 breaks down why it happens by removing specific agents one by one. The values indicate the difference in Sharpe ratio, where positive numbers mean the fine-grained approach is still superior. Notice that most configurations, like removing the news or macro agents, show positive values, confirming the system's robustness. But the second row, without technical, tells a different story. For larger portfolios, the difference turns negative. This implies that the technical agent is the key component driving the fine-grained model's advantage. So, Table 2 explicitly quantifies the contribution of each agent through ablation studies. The top panel focuses on the fine-grained setting, where the first row shows the baseline Sharpe ratio, and the rows below show the change when a specific agent is removed. Notice the row for without technical. The values are deeply negative, confirming that the technical agent is essential because taking it out significantly hurts performance. Surprisingly though, removing other agents like quantitative or qualitative often yields positive numbers, which suggests that in this specific setup, they might actually be introducing noise. Alright, moving from internal ablations to portfolio construction, Figure 3 illustrates the benefit of diversifying between the market index and the AI system. The chart plots the Sharpe ratio as the allocation to the agent strategy increases from 0 to 100% along the horizontal axis. The orange line represents gross performance, while the green line accounts for transaction costs. Notice that both curves form a distinct arch, peaking around a 40% allocation. This shape indicates that a blended portfolio significantly outperforms either the market index or the standalone AI strategy, proving that the system's low correlation with the market creates valuable diversification opportunities. Well, Figure 3 visualized the curve, but Table 4 provides the exact numbers behind that diversification benefit. We compare the market index, Topics 100, against the standalone agent strategies and a 50-50 blended portfolio. Focusing on the net results on the right, notice that while the index alone yields the highest raw return, the combined portfolio reduces volatility to just 8%. This drop in risk pushes the net Sharpe ratio up to 1.91, which is significantly higher than either the market or the AI agents alone. Wrapping up, 2 takeaways stand out. Structure matters as much as raw intelligence, and mimicking the fine-grained workflows of human analysts significantly boosts performance. This suggests that the future of financial AI relies on precise task design rather than just bigger models. That's it for this episode of the AI Research Roundup. I'm Alex, thanks for listening.